Okay, so you guys can all hear me well, right?
Yep.
Okay, excellent. So let me just take a measure of my audience here today. So how many of you are founders or CEOs of a game development studio? Wow, quite a few of you. That's good. How many of you have ever sold your company to another company? A few hands here. This is good. I'm glad. Excellent. How many of you have ever taken investment from a third party for your studio? Quite a few. Excellent. Good. All right. Well, it looks like we have the right crowd today, and I'm happy to be speaking in front of you. This is just a bunch of questions that I hope that I will answer in the course of the next 50 minutes or so, and I'll also have some time for Q&A. So please have some questions, because my wife and daughter are in the audience, and I'd like them to feel like people are actually engaged with my talk. And if I, for some reason, have not answered or addressed all of these questions by the end, then please call me out. I'm happy to do so. Just a quick slide on me so I don't have to talk about myself. Moving on. We'll start with investments. So today I'm going to talk about investments and acquisitions. They're related to each other, and it's part of the work that I do in my current role. Since I left Microsoft, I started an organization. We're a firm that does strategy consulting and acquisition advisory for game developers. And so obviously investments are one part of the whole acquisition story. And a lot of you guys, when people start a game development studio in the industry, they set out usually to make great games. And that's the way it should be. But a lot of times they don't actually think about the studio itself as a business. And I like to think about studios as a business, so that's why I got into this role. So let's talk a little bit about investments. You know, why would you take an investment? Well, some of the obvious reasons, right? Because you have a, let's assume that you've already got a development studio up and running, you bootstrapped, you're making games, and then suddenly someone comes to you and says, hey, we're interested in investing in you, or would you like an investment? Or you go out and you're seeking it. Why do you take it? You take it because, at least I tell my clients, don't just take money because you can take money. If you take money so it sits around in a bank account, that's a foolish use of your capital and your equity. Take it because you have a concrete strategy and you need capital to execute against that strategy. Take it because the investor is somehow offering you skills or capabilities or resources that you need to grow the business. Maybe you should take it because you've been working a long time and you want to take a little bit of the money off the table and into your own bank account so you feel a little more secure and confident every day going into work. That's okay. That could be an okay reason if you've succeeded well enough in your business up to that point. Maybe you're taking the investment because you're hoping for an acquisition from the investor down the road. There are a few strategies, a few reasons why that might make sense. It can also come back and bite you. We'll talk about that. Or take it because the alternative is shutting down your development studio. That's clearly kind of a no-brainer. If you have nothing else going for you and you're looking at the end of the road and an investor comes to save the day, definitely that's something to consider. But what are your risks? You know, you may ruin your chances of attracting acquisition interest down the road by taking on a certain kind of investor. What do I mean by that? I mean that if you're up against, say, Tencent and NetEase, just hypothetical, right? Or publisher A and publisher B. Publisher A says, I want to take 10% or 20% of you, and so you let that happen. A couple years later, you've succeeded really well. Publisher A, who is your investor, is pretty happy with the investment. Publisher B comes along and says, hey, I want to buy you. I want to buy you for $100 million. And you're like, wow, that's actually a pretty good offer, I think, so I'm going to take that. But then investor, of course, publisher A is your investor, also has to know about this deal and says, no, you know what? I'm just going to pay you $120 million. And so, of course, you're going to take that, right? And the reason why he can afford to, publisher A can afford a $120 million offer on you is because 20% of that comes back to them, right, if they own 20% of you. So they always have a discount to bid on you against anybody else. And every other publisher is savvy enough to know that that is the case. So that's why they won't bother coming to you with an offer, because they know that they'll be working at a disadvantage. And as a result, there is no mechanism to force an acquisition from investor A unless they want to. And so that's what I mean, right? When you're taking an investment, you're actually giving someone a blocking position potentially on a future investment down the road, and it's something that you have to be conscious of. Doesn't mean you can never get acquired by anyone else. It happens. It's just a big demotivator. The other issue is you might lose some autonomy to someone whose goals are not your goals. Like a lot of times, people take investment money and they feel like suddenly because we're all in this company now, our goals are aligned. But that's not strictly the case. You know, if you have a strategic investor, they have their own purposes for investing in you. They have certain things that they'd like you to do, potentially. Or maybe they'll leave you alone. But anyway, you have to be conscious of the fact that your interests and their interests may not be the same and may not remain the same over time. And what do I mean by loss of autonomy? It doesn't mean that you don't control everything anymore. You may still. But if they buy a sufficient portion of you, they have a right to ask for a board seat or a couple of board seats. And so suddenly you are reporting major decisions to them. They do have input, even if you still have majority control. And so when I say loss of autonomy, it's the loss of the flexibility that you had to control everything in the past. And that may not be a big detractor for you, but it may be, so you have to know. And also, when you have a large position owned by a competitor, other publishers may not want to do publishing deals with you or business with you. You know, when I was at Microsoft, and I think it's pretty indicative of most publishers, if someone had a position from an investment from a competitor, we were kind of loath to use them for work for hire or publishing original IP, simply because those are confidential projects and we don't want that leaking to our competition. And no matter what you say about Chinese walls, we kind of believe that they're gonna know. The other risk, of course, is you're seeking these benefits, like maybe a greater distribution capability, or in some part of the world that you're not strong in, or marketing resources, or other things that you were looking for, UA capability. You may not get those benefits that you wanted by taking on the investor in the way that you thought. And then the other last point is that, you know, whenever you take an investment, it's based on a valuation. And you may think the valuation is helpful to you at the time, but for various reasons, it may not end up being helpful to you to be set at a certain valuation because you're trying to give out stock options or you're trying to buy out another co-founder at a lower valuation. Like, there are lots of reasons why an investment can set a valuation that may not be a good precedent for you. And then quickly just go through the types of investors. So there are, of course, the angels, the friends, the family, some say fools. Those guys are there mostly because they want to support you, right? And they want long-term capital gains, hopefully, if they're somehow financially savvy. But they're putting in money because they believe in you and they want to support you. And that's emotional money, right? You don't want to screw over your friends and family. It's a good signal to all the other types of investors that you're going to try really hard and you have skin in the game because you don't want to let your family down. So that's nice. But usually, angels, friends, and family don't always carry the day. And when you need more money, more capital, then you really rely on the other two types of investors. Financial investors, and I like financial investors. Financial investors, like, they're all about return on investment, right? Future liquidity at some sort of target ROI. That's a very easy thing to understand, and in general, it aligns your goals. The only times where you really aren't aligned could be if they want to exit within a certain window. Usually these financial types, they want to be out within 5 years, and at some point, you may have to buy them out and come up with the capital for that. So be conscious of that sort of understanding among them, what their goals are, what their timelines are. What happens if I haven't sold in 10 years, right? And then it comes to the last type of investor, And this is the most common type in the industry today, the strategics. The strategics are any publisher, any interested game entity. They are not just financially driven, they have a strategy. So an Activision, a Microsoft, a Tencent, a NetEase, all of those guys are strategic investors, ad tech companies, right? Startups that are well-funded that need to do something in the game space. All those guys have strategic reasons that they want to invest in various development studios other than a return on investment, which is part of it, but not the big part of it. So, they want to find some of them want to find a blocking position against competitors buying you out down the road, and that's really their target. They won't tell you that. Some of them are looking for synergies with a platform or some IP portfolio that they own. Hey, if we invest in you, you can get a cheap discount on licensing our IP and making games with it, and we can work together. That could be great. That may not be so great. Or synergies with a platform. If they're creating a new platform and they want to make sure that they have you locked in for that. Or sometimes they just want an option to acquire you in the future, which could be a really good thing, but bear in mind that you're potentially locking out others who may be eager to buy you down the road. Just one quick example of kind of a worst case scenario if someone invests in you. Let's say that a developer signs a publishing deal with an Asian publisher. This is based on kind of a true story, actually a true story. They take a 20% position, no board seat, all good. They do a development project, so they're also publishing, and so then the studio's working together, they're working for a year or so. During the course of that project, one of the founders of the studio leaves, and there's a right of first refusal from the company, right, to buy his shares out. But the other founders don't have sufficient capital, so they can't buy it out. But guess what? The investor has sufficient capital and decides to buy the position. So now they have a 35% position in your company. That's a pretty hefty position, so they want a board seat. So now you've created a board, and you formed from an LLC, you've gone over to become a C Corp, and now you've given them a position on the board, and they're kind of watching all your moves. They're not interfering, they're just around. But then at the end of the project, just before launch, another founder leaves. This time, the other founders have sufficient capital to buy them out, but the investor has tag-along rights, so it also has a right to buy proportional amounts of the stock. And so now they're at a 40% position, which means they still have that board position. Unfortunately, the project that you did together, it didn't go well. And then the investor decides, you know what? I'm not going to do another publishing deal with you guys, but we still have a 40% position in you. Good luck. And then you go around and you're pitching all the other publishers. And then once they ask about just, who you are, who owns you, that sort of thing, they realize that 40% of you is owned by their competitor. So as much as they love your pitch, they actually decline to do any kind of deal with you. And now you're kind of dead in the water because you don't have capital. You've got a large position from a person who is not currently doing any sort of project with you and has no intention to do so, and all of their competitors are afraid of that position and they're staying away from you. And now you're starting to really, really struggle. That's the worst case scenario. Let's talk a little bit now about acquisitions. So in acquisitions, why should people sell a studio? There's some good reasons, there are some bad reasons, right? The good reasons, because your life and your priorities, they've changed. You've realized earlier goals, you're ready for new ones, and because someone offers you so much money that it's better than operating independently. So what are some poor reasons for selling your studio? Because you're disillusioned or tired. This is very common because there's a bigger problem in your business or with you. So in other words, you see that the business is going down, or you're working on a second or third or fourth project, and you see it's not going to go very well, but you've overinvested, and you're just kind of looking to get out. Or there's some problem. Maybe you have a health problem. Maybe you have a divorce among one of your founders and an equity split. So the reason why these reasons to sell matters is because it tells you whether you are going for a commodity or a premium sale. So I'll tell you the difference, right? A commodity exit is otherwise known in the industry as an acqui-hire, right? An acqui-hire is basically a company coming in and they're saying, hey, you know what? We'll just take over all your employee contracts, we'll pay you a little bit for all your hard work, and now we own your company. It's great for avoiding bankruptcy court. It's great to make sure that your people continue to be employed gainfully by someone. But it's not going to be a huge payday for you for all your hard work. Right? You can expect a pretty low value for your studio. And as a result of the fact that it's not very much money, we're usually talking a couple million here, if that, then the pricing is going to be pretty generic. You're not going to have a lot of leverage. You can't bolster and say, hey, you know, I want $20 million, because you're not in that position to negotiate. So there's no creativity around negotiations. It's a pretty straightforward deal. It gets done fast. Versus what I call a premium exit, which I think should be the de facto strategy for anyone who's trying to set up a game studio as a business. Right? So you want to create a high valuation for your studio driven by assets that you have, that is IP, franchises, all that, and by your cash flow, not by your employee headcount, by the way. So some people are like, I have 400 people, so I'm worth blah. But you know, like we've sold studios of 12 people for 250 million and studios of 100 people for 20 million, right? The difference is about what you own in terms of IP and what you own in terms of the cash flow that's being generated by the business. You're trying to find a strategic place to a buyer. So a buyer looks at you and says, you know what, I need these guys. I need these guys to make X for me. I need these guys because this franchise could be more valuable if I owned it. I need these guys because they make a certain type of game and I want to be big in that type of game. So you want to create yourself as a studio that someone else wants to buy because it's strategic. Because when it's strategic, then the valuation is high and negotiation is tolerated. Right? So there's a lot of back and forth about the negotiation. What's the price? What's the structure? What are the terms and conditions? How will I work with you? Like these kinds of negotiations can take months. They're extremely complex with a lot of moving parts. And the buyer puts up with it because it's really, really important to them that they acquire you and nobody else. And this greater deal value, right? That creates the tolerance for negotiation. So commodity exits, one more thing I'll say about them. A lot of times if you have to sell, right, something's forcing you to sell, you'll go to an investment bank. That's generally what they're good at, is they do this thing they call running a process. So they'll run a process on you, they'll create a bunch of, they'll create a little portfolio or booklet that they'll show around and they'll take you on a road show to a bunch of potential buyers and they'll say, hey, look what I have today for sale, right? It's good. But generally, in our industry, it's not like tech in Silicon Valley where you're selling a piece of technology that someone could plug into a bigger vehicle and it's worth a whole lot of money. You're talking about people that make a creative product again and again. And so when I hear, when I used to be a corporate buyer, right, on the Microsoft side, investment banks would come to me and they say, hey, these guys are for sale. My immediate thought is, well, what's wrong? What's wrong with them? Like, are they tired, or are they dying, or someone going to have a divorce? Like, I don't see that as a good thing. I see it as a bad thing. A couple of bad things happen when this happens, right? First of all, immediately, whatever valuation you had takes a tumble. They know that you're desperate to sell, and so they're willing to take advantage of you if they can. And no matter how much you ask for, that's the ceiling. No one's ever going to pay more than that. The second thing that's going to happen is if they're publishers and they were doing business with you or thinking about new business with you, guess what's going to happen? They're going to pull back because you're up for sale. Why would we do a deal with someone that's going to be sold to potentially a competitor? So you strangle yourself in the process. If you don't sell, you're going to be in real, real trouble. So if you have to sell, for all the reasons we just talked about, then definitely procure an investment bank, put yourself through a process. That's what they're good for. And it's by all means try to avoid bankruptcy and keep your people employed. But I would rather that your exit is a premium exit, right? That means that you grow your company so that buyers come to you, right? That you hold some sort of unique position in a valuable space in the industry that you have aimed yourself towards. And that you own valuable IP, hopefully a franchise, not just a one-off game, but you own valuable IP or services that generate a profit. The other thing is to cultivate a reputation. Because we're in a creative industry, we have a lot of crazy people, and we have you know, people are known for doing crazy things. But if you develop as a developer a reputation for quality, for consistency, for maturity, and for sanity, that's a really, really good thing. It shows that you're easy to work with. Also, this is one thing that I always point out, but in the course of your business as a developer, you're going to do deals with multiple parties, hopefully. Don't get sucked into being only with one publisher or one company, because there's a high likelihood that the company that takes you out, that buys you, is someone who you have already worked with. And so when you're thinking about deals, ask yourself the question of, do these people buy companies? Do they have deep pockets that they could afford to buy me for a high valuation one day? And then align yourself with them for a deal or two. Because it's good to date around, right? Nothing makes a publisher that you've worked with more jealous than working with a different publisher. So where does valuation come from? How do we figure out how much you are worth as a studio? It's this thing in finance we call enterprise value. What's the value of your enterprise? The sources of value are EBITDA, first and foremost. Earnings before interest, taxes, depreciation, amortization. In other words, it's a common financial measure of your profit as a studio. If you don't know what your EBITDA is, it's probably time to find out. There's past EBITDA, historical EBITDA. There's the EBITDA you're running this year. There's the EBITDA you project for next year. All of these could be a basis for your valuation, depending on who the buyer is and their willingness to do so. The next source of value is intellectual property. What games do you have? What technology do you control? The next is, let's say you're in the mobile space, or you've got a very popular PC console game. Right? You have users. Can you cross-promote those users? Do you control and can you message to those users? Owning users today is its own form of currency. 10 years ago, we probably would not have counted this among the list. Now it's one of the higher things. A well-managed organization with strong middle management. I'm going to say this one again and again, because as people grow their studios, they start to feel like they can't control it all, and they can't. And you have to hire middle management. But sometimes you are reticent to hire good, strong middle management, might be even better than you, because you might lose control. Well, I don't want you to think that way. I want you to think yourselves as gaining more control if you hire people better than you under you. And the reason why is this, right? If I'm buying a company for $50 million, and it's a 50-person company, right? If I'm buying you for $100 million, and I know that slavery is illegal in the United States, I can only keep you working for me with incentives for maybe 2 or 3 years. Why would I pay you $100 million if you are the whole creative genius and driving force of the studio, and you're going to be gone in 3 years? I'm not going to do that. I'm only going to do that if you give me an organization that doesn't need you. So you have to replace yourselves to make yourselves valuable. And then you have to have a proven ability to consistently produce great work in a specific area. So it's one of those things that we look for when we're buying a company is, can they reproduce what they did with that one great hit? And if you've done it 2 or 3 or 4 times, that lends value to the valuation, right? It increases the valuation. If you've only done it once and that second product looks a little shaky, it definitely lowers your valuation. It's as simple as that. And then also I'll mention some people own patents, and patents can be valuable. So if you have worked in VR, AR, for example, and you have created something that you think is patentable, this is a good time to perhaps look at the feasibility of those patents, right? In any new area, let's say in the next 5 years, there's probably cloud, game streaming, right? If you have come up with something new and you can patent it, it might be valuable to you down the road. So consider it. Here are some rules that I love to do this because it's easy for me to say, but it's really, really hard for you guys to do it. But let's be on the table, let's talk about it. Rules to building up your enterprise value over time. 1, always make great games. And I mean always, right? That's the only job you really, really have to get done as a developer. It doesn't matter whether you're doing a work-for-hire game or whether you're making your own IP, you want to make the best game possible. The most important part of any game budget, in my opinion, is the last 10%. Why? Because the last 10% is that time that you dedicate to polish your game, to fine-tune it, make it feel good, make it fun, right? Make it look good. And that 10% can easily go away if, for example, you use an agent. So I'm not against agents categorically. I have a lot of friends that are agents and do that work. But the business model is something that I find a little bit troubling, right? Because agents are in front of all your deals and they get you work if you're a work-for-hire studio, and they take 6 to 10% of whatever the project was. So where's that money coming from? It's coming from your polish budget. So as a result of having an agent, you actually can often take away your ability to make great games, and you just make merely good ones, and it cripples you. So that's just something to think about. So then the other rule is always, always, always fight bitterly to own your IP and your users, control your users whenever you can. Now sometimes, let's face it, it's just impossible to do. You don't have enough leverage, you don't have enough capital, but you should always put up a good fight on that point, if nothing else, because that's going to be the center of your valuation one day. The next third thing, always have a strategy. And you're like, of course you're always going to have a strategy. Like, I'm going to make a great game. It's going to make a lot of money, duh. That's actually not a strategy, right? That's just a wish. But a strategy is to say, who are we? What do we want to be? What are we passionate about? Where are the holes in the industry? Where's the white space? What are we going to fill? How are we going to do it? That's strategy, right? Avoid any gaps between paying projects. This is so easy to say, and it's so nonchalant, but it's the truth, right? 80% of the time when a studio goes under, it's because they've faced a gap between paying projects. And it's hard to avoid. So I'm going to give you a piece of advice. Always be doing biz dev. It doesn't matter. If you're one team and you're locked up for the next 2 years, I don't care. Like, go talk to publishers all the time. Go pitch stuff every now and then, even if you have no capacity to produce it. Create interest. Make sure you have relationships. And even if they say, you know what, we love that pitch. Like, we want to sign it right away. Get work in 4 months. What do you think? And you'd be like, you know what? Our capacity just got taken. Sorry about that. Like, let's kick it down another 6 months down the road and we'll talk about it again. Just keep pushing it down. It's okay. It's a survival mechanism. Publishers, I used to call developers all the time as a publisher and say, hey, do you have capacity? And the smart ones were always like, yes. And I knew they wouldn't have capacity, so I'd do my own independent check. But that's the point. You got to be out there hustling, right? That's the way that you avoid a gap. And then this is the most important rule. And I know it's really, really hard, but I'll tell you why it's important. It's what I call, with my clients, the 6-month rule. The 6-month rule is always have 6 months worth of payroll in your bank account. Give yourself 6 months worth of runway. Why is that important? Because most developers are out there with 1 or 2 months in their bank account. And it's no way to live a life, right? It's scary. And the fact is that if a publisher that you're working with comes and protests your deliverable, they say, hey, you know what, we're going to hold back payment until you fix this deliverable, you start to sweat it. right? And you're going to say yes to anything because you need that money, right? 6 months is the difference between saying yes and no, being able to protest, right? Because if you can say no in this industry, you have enormous power, right? If you have 6 months and you've been pitching and then a party comes to you and says, we want to sign a development deal, you can still afford to wait until that second or third party also gives you a deal. And you can start to negotiate between them, and you'll have actual choices. Or when the publisher starts to screw with you, you can say, you know what, screw you. I got money in the bank. I can find another project. Let's just cancel this thing. And they'll be like, okay, well, hold on. Sorry. We kind of lost our heads. Obviously, you guys aren't going to be pushed around, so let's be a little more reasonable. I've seen it happen all the time. It's the ability to have choice and control in your industry as an independent developer. It's so important. A few more rules I'll cover really quickly. Take as many shots on goal as you can. This is a hit-driven industry, right? And as a former biz dev guy, I can tell you that the best biz dev guys know there's no predicting success. Sometimes, as I like to say, you have like the good-looking devs, and then you have the stoners in the corner. Sometimes it's the stoners in the corner. You just don't know, right? Success comes from anywhere. Lightning hits everywhere. Next, always be upgrading your team. Like when you start with the resources that you got. You go to war with the troops you have, not the troops that you need, right? But then as you get a little more successful and you have money and you have a reputation, you should start to look around and say, you know what? Maybe he's not the best engineer. And maybe my cousin Vinny's not that great at art. Like always be upgrading your team. Always make yourself better when you can. And then, as I pointed out before, hire excellent middle management as you grow and empower them. Step back. Don't micromanage. Don't be a controller. Let them do their work. And then, as I've also said, seek business with guys that can take you out down the road. Because that's really, really important. Let's talk a little bit about offers and deals. So first, a meditation on valuation. Where does valuation come from? So technically speaking, financially, valuation is about a stream of expected cash flow from the perspective of the buyer. This is important. See, from the buyer. It's not from you. So it doesn't matter if you think you're worth 10 million or 100 million. What only matters is what a buyer is willing to pay for you. And it can be that two buyers come to you. One buyer says, hey, I think you're worth 50 million, I want to buy you. And another says, I think you're worth 80 million, and I want to buy you. Both of those buyers are right. Both, if they're being honest about your valuation, both of those buyers are completely right in their estimation of your value because it's what you are worth to them, not to yourself. Does that make sense? So it's actually kind of deep. But corporate buyers do all sorts of analyses to try to figure out value. The first one, and the biggest one, as I've mentioned before, is EBITDA. So they'll take this measure of profit, and then they'll multiply it times a standard industry multiple to figure out your valuation. So let's say that you make 2 million EBITDA a year off of 6 million revenue, right? So, and that's historical, so last year's revenue. You're making 2 million, and your growth is kind of like this, slow and steady wins the race. We'll probably apply a 6 or 7 time multiple on you, right? So you're worth 14 million. But if you're growing 100% year over year, you might command an 8 time multiple or a 9 time or even a 10 time multiple, right? Some Chinese publishers during the heyday, they were paying out not on EBITDA but on earnings. But they were paying you somewhere between 10 times to 15 times earnings. That's a lot of money. They could do it because they were public companies that traded on the stock exchange in China for 60 times their multiple. So if they bought you for 15 times earnings, it's accretive to them because that money that they got from you, that 2 million or 20 million, that actually was multiplied times 60 for them in their stock valuation. These are some more analyses that any publisher that's trying to buy you or any entity that's trying to take you out are going to run. They're going to run a DCF, a discounted cash flow analysis. They basically plug you into their distribution platform and their engine, and they'll figure out, like with the games you'll make together over time, how much cash will flow out, and then they'll put it into present value terms by looking at their weighted average cost of capital, and then they'll come out with one number, and that's how much you're worth. It's actually a little more involved than that, and it's more of an art than a science sometimes, but that's what it is. Otherwise, they'll look at comps to other companies your scale, your size, and they'll say, oh, they sold for 13, so I think these guys should sell for, 20. So comps are common. The only problem is there's no real objective database that talks about the structure of a lot of these deals, so there aren't a lot of comps out there for people to use, but if they have their own internal numbers, they'll use those. The other analysis they're going to run is something called a build versus buy. So they'll say, hey, here's a studio that makes first-person shooters, and there are 50 people, and we have an IP that's great for first-person shooters, and we don't have a studio, so we need to make a studio. If we made a studio ourselves, hired 50 people, had them make a game, and brought them together as a team, how long would it take us and how much money would it take us versus buying these guys outright? And they'll do the build versus buy scenario. And remember, there's a time to market. Just because you already are a team and you're proven, there's less risk. So there's some value in there. And that's how they kind of figure out also, like, what is it worth to them? But then, this is the most insidious thing. And as a former corporate buyer, I also engaged in this. We also try to figure out what your number is, right? Because even if we know that you're worth 50 million, if we could figure out that you actually would sell for 20 million, we're going to make a $20 million offer. So that's why we're going to take you out. We're going to take your spouse out. We're going to take your kids out. We're going to see what kind of car you drive, right? How much your house is worth. We're going to figure out, well, have you had an exit before? Have you made a lot of money before? Are you sitting pretty, or are you kind of lean? Is your wife eager for that boat, right? Because if we can figure out that you're hungry or that any of your other founders are hungry, then maybe we could force a sale at a lower price. And so that's why you got to be careful with all the whining and the dining and the table and the small talk, right? You got to present yourselves as people that are serious and firmly united as a team, not to sell for less than you are worth. So let's talk about the L.B.O., not a leveraged buyout, but the lowball offer. A lowball offer almost always precedes a legitimate offer, right? So what they're doing is they're trying to come and they're trying to figure out your number, right? So these people come all the time. 9 times out of 10, it goes nowhere. But what they do is they say, hey, you're valuable. I think you're valuable. What do you want to sell for? So don't tell them a number, right? You can ask them, well, what do you think we're worth? And they might give you a low number like, oh, I think you're worth $500,000. I think you're worth $2 million, right? And what they're hoping for is that you'll be like, oh, heck no, I'm worth 1.5 times that, right? They want to shake the tree. They want some value to fall out. Don't fall for that. You can I'll tell you what the script is in a second, but once you send them packing nicely, it may take another 6 months before they come back. They can't come back next week and say, you know what, that $2 million is just kidding. I really meant 20 million. Like I suddenly realized I calculated wrong or something, right? Like they can't do that because it's so obvious they were trying to cheat you. So they wait 6 months and they're like, hey, management changed, or you know what, you guys have been doing some great work lately, like we value you higher, or you know what, our method of valuation has changed and we appraise you higher now. They have to wait. So if you get a lowball offer, it might be something down the road, but great chance that it's actually nothing, it's just people looking for value. Here's how to respond to a lowball offer, right? Be polite, thank them for their interest, let them know when they ask you how much you're worth that selling has never really been your priority. The best valuation comes when you're not for sale, right? And that operating your business is your priority. Let them know that if you were to ever sell, it would have to be at a reasonable valuation. And if they give you a number that's way too low, it's like, yeah, it's not really worth our time to engage in that. We'd rather just focus on our work. Let's stay friends. And then you just have to wait and keep doing amazing work and focus on the job. So, I'll have to say this. A lot of you in your time are going to make lots of deals. You're going to make publishing deals, you're going to do distribution deals with lots of entities. There'll be such volume in these kinds of deals, and you're intelligent people, you're totally capable of doing it. But when it comes to an acquisition, it's very, very different. An acquisition can be a life-changing deal, and it's something that most entrepreneurs only encounter once or twice in their life. And you're up against people that do this every day. They're paid to do it professionally. They'll look at 20 targets, they'll close 5 deals a year. And so they have what's called deal flow, and you don't have deal flow. It's like the old days before the internet, if any of you can remember that, you tried to buy a car. There's an enormous information asymmetry. You just didn't have a lot of information. The internet has made that a little more even these days, and that's great. It's given us tremendous power as buyers. But in an acquisition, it's easy because there's so many things to consider. It's easy to screw yourself, frankly. So I would say with negotiating an acquisition, please, whoever you get your help from, as long as they know what they're doing, you should get help. Don't do it by yourself because you wouldn't climb Everest by yourself. Align your major shareholders before to avoid fracture, right? So some of you might have gone through an exit and be independently wealthy already, while your co-founders have not. That means your number will be different. Like this guy will sell at 10, you might not be willing to sell except for 100. And that can cause a fracture and a rift in an acquisition scenario, and you don't want that to happen. You want to be unified. So it's good to discuss this before an acquisition offer is ever made to you, and to be aligned at the number at which you guys are willing to sell. I'd say about acquisitions that there are a few things that matter even more than the price. First, your comfort with the acquirer and their plans for you, that matters more than anything else. How are they going to treat your employees? These guys have worked hard for you, right? You care about them. You can't help it. So what they do with your studio and your people should be of primary consideration. And then, before even size of the deal, is the structure of the deal. And I'm going to talk about the structure real quick. And then after the structure, if that's good, then you can worry about the size of the deal. And also, ancillary to that is the tax efficiency for you as a shareholder of the company. Because you don't want to be in a situation where you've made a lot of paper money and the government says you owe them real money, but you don't actually have real money yet. So, making a deal. First of all, you read a lot of things in the paper, in the trade press, right? Oh, so-and-so sold for 180 million, so-and-so sold for 800 million. Don't be impressed. Publicized deal values are always misleading for various reasons. And don't be impressed until you understand the structure of the deal. So what is deal structure? Typically in a deal, there are 2 components. There's the assured component, otherwise known as the guaranteed component. The assured portion is what you're guaranteed to get paid no matter what. And then the contingent portion is otherwise known as an earnout, and that is contingent on you meeting whatever goals or key metrics are specified as part of the earnout over some time frame. Okay, and I've given you a kind of a rough split. The old Chinese deals that were being done were usually like 50% and 50%. Assured versus contingent. The assured was often in cash, not in shares. And the contingent portion, the earnout conditions could be generally pretty good. If you work them out, they could be very reasonable and in line with whatever forecast you gave them. But anyway, so this is the key thing to understand about deal structure, right? The assured portion isn't usually paid in the first year. They want to try to handcuff you, the key founders, to the deal, so they're going to pay out over a period of 3 or 4 years. And they'd like to be, a lot of people need to be paid in cash. You need some portion in cash because even if they pay you all in stock, you're going to owe taxes on it, and you have to pay those. And by the way, there's usually a lockout period, so you get the stock, you can't trade it right away because that looks bad. or for a variety of reasons. So they'll lock you out from selling for a year or 2 years. If the stock tanks, guess what? You still owe the government what it was worth the day that you got them. So that could suck. Earnout portion. So the earnout is, of course, one of several if-then clauses, right? If you make this metric by year 3, if you're making EBITDA of X amount by year 2, like, then you get this. Try to get away from a binary contingency. Try to get a gradated contingency so that you don't completely miss the target because you missed your measure by $1, right? And this is often used, the contingent portion is often used to close a valuation gap. So if I, as a publisher, say, hey, I think you're worth 50 million, and you say, you know what, I think I'm worth 80 according to my plan, then they'll say, you know what, since we agree on the 50, let's do that. Let's make it 50 for guarantee, and let's make it 30 more additional if you meet the following metrics. Right? So they use it to close a gap and prove it to me. Part of what's important about an earnout is that you be left autonomous enough to meet the earnout so that you have control. If you don't have control, if they're making all the decisions, it's not fair to put you under an earnout. So there have to be, in the agreement, some understandings of the rules of the game, how much control you have over your studio versus them. They're going to have some control over budgeting. So there's quite a few things you actually have to work out. But everybody does work it out if you're smart. So, some more warnings about what to do. When people come to you with an offer, or before they come to you with an offer, they're going to ask you for information. And I want you to be really, really careful about when and how you provide information and what kind of information, okay? First of all, just know, an offer is not an offer unless you have it presented to you in writing somehow. If someone talks to you at a cocktail party, that's not an offer. If someone just says it to you over a table, you know, slyly, hey, 30 million, like, that's not an offer. Like, if it's in writing, it's an offer, okay? Hopefully, it's not just a dollar amount, but it's a whole term sheet that explains the structure of the offer. It's not binding. They can always do due diligence, and then they're going to find some things that they didn't expect, and they can pull the offer back. That's fine. But they should be willing to state how much they think you are worth. The buyer is going to ask you for all this information, so I want you to be really careful, okay? They're going to ask you for your financials. How am I doing on time? Okay, so they're going to ask you for financials, you know? Sure. You say, sure, I'll show you financials after you show me an offer. Right? As part of due diligence, I'll give it to you. Show us contracts and documentation that you have. I'll do that after I get an offer as part of due diligence. Show us your product roadmap. I can talk to it, but I can't take you into detail until I get an offer. What's your EBITDA? Is it growing, stable, shrinking? If you got EBITDA, you can sketch out, you can say what you have. But I wouldn't give them a full P&L or balance sheet yet. And then if you don't have EBITDA, if you're not making profit, I would say, hey, we're still investing in our growth. You like that? So I've got some other things. You'll have access to these slides. I'm going to run out of time, but I'm going to just show you this because I think this will be helpful. Typically, closing a deal takes 6 to 9 months. It's been faster sometimes, been slower sometimes, but in general, the parties want to get stuff done quickly. Over these kind of mythical 6 months, here's what kind of happens. There's an initial discussion. There's a written offer and a term sheet. The term sheet gets signed, and then they create a long form. And then the due diligence process begins, and their troops kind of rain down and look at your financials and your contracts, and they look at your staff, and they do this thing called employee slotting, where they figure out what level each one is going to be in their new org, and whether they're going to keep them or not, or make them a special bonus plan or not. Then you're going to negotiate the fine points of the long form agreement, but most of the hard work's already done at that point. And then you're going to hold your breath, and you're going to hope for the deal to close. And in between, at the bottom there, you'll see all the stuff that happens. There's deep soul searching, recrimination, right? There's a lot of angst. So these are all the answers I put up in the beginning. I hope that I answered all of them. If not, call me out on Q&A. And that's my business partner, Bob, and I. Thank you very much.